Alright, welcome to class 2 of the Trading Handbook Day Trading 101, Article 1, Section 2, Terminology by yours truly, Relentless Trader. Now, class 2 has been long overdue, so let's get right into it. So, quick disclaimer, of course, I'm not any of these professions listed here. This presentation is strictly for educational purposes. So let's get right into it. The SEC, right? These are all terminologies that you guys are going to need to know and be familiar with, to stay up to par in the market and not be confused, like some other beginner traders are going to be. So the SEC, the Securities and Exchange Commission, is a federal agency that has the responsibility for regulating the various stock exchanges. Now, if you guys think of the FDA, right, that's the Food and Drug Association. Now or administration, I should say, they're in charge of like all prescription drugs and things like that the pharmaceutical companies will bring into the public. So they test the drugs and make sure that they're actually safe for you to use. And now the SEC is very similar in that fact that they watch over stocks and make sure that there's not any fraudulent activity going on. So it also oversees the securities industry and promotes full disclosure in order to protect the investing public against malpractice in the securities markets. So that's what the SEC is. They pretty much regulate stocks and make sure that everything is safe and everyone is following the rules. And this is a government agency, so you want to know this. So going right into stock splits, right? This is an interesting one. A lot of individuals have trouble understanding what stock splits are. So let's get into it. So and there's two types. This is a regular. So a stock split refers to an increase in outstanding shares, and as the float increases, the price of the stock decreases in a relative manner. So this action is done in order to reduce the market value of a stock. When the market value decreases, your shares are accounted for as it will increase. Now, a regular split is usually done on a strong moving company, right? A very strong moving company. So let's look at Amazon, right? Because I know sometimes the definitions can be a little hard to understand, right? Sometimes an example is usually the way to go. So if we look at Amazon, right? Amazon is currently, it's a very expensive stock, right? It's $2,000 for just one share. If you want to buy one piece of Amazon as an investor, it's going to cost you $2,000, right? Very, very expensive. So what will happen is that the board of directors will come together and say, hey guys, we're not getting enough people to buy our stock because the price is simply too expensive. The average individual don't have that amount of money laying around. So what they'll do, they'll decide, you know what, let's bring the price from 2,000 to 200. So essentially the price is being divided by 10, right? So that 2,000 divided by 10 becomes 200, right? And let's say you owned one share of Amazon at 2,000. That because the share price was divided by 10, the amount of shares that you own, which is that one share, is now multiplied by 10. So if you do 200 times 10, it'll still equal out to $2,000. So at $2,000, you had one share. Now at $200, you have 10 shares, and 10 times 200 is 2,000. So it equals out, and that's how the stock splits work. Now, as I mentioned, there's two, and there's the reverse stock split. So a reverse stock split is literally the complete opposite, right? So a reverse stock split is a corporate action that decreases the number of a corporation's outstanding shares. This action is done in order to increase the market value of a stock. So price goes up and shares personal shares decrease. So when the market value goes up, your shares are accounted for, and this is done with a weaker moving stock. So let's say you have a stock at 50 cents. And the board of directors come together and they're like, hey, you know what? This stock is too low. No one wants to buy it. Let's increase the price so it becomes more attractive. So it's literally the opposite mechanism of what we just explained on the regular stock splits. So let's throw a situation in there again. Let's say you have a stock that's at 50 cents and it's a little too cheap, and they want it to go to $5, right? You know, they'll be goodness, that'll be 10 to 1 or 1 to 10, I should say, where the price will be multiplied and your amount of shares will decrease as the price goes up. And the math always relates, so there's nothing to worry about. One day you might open up your broker and you realize, oh my God, this stock was just at 40 cents. Now it's at $4. I'm up so much money, but you'll sell and realize, wait, I only made $5 or something like that, and that's because the stock didn't really go up on news. They had just had a reverse split, or vice versa. If it's really high in price, like Amazon is, and goes down, they had a stock split. It's not that you lost all your money. So you definitely want to know these two and be familiar with these two terminologies for sure. So circuit breakers. Now this is the next thing you're going to want to be familiar with. Now, breakers are precautionary methods used to slow down or stop the movement of a stock or index. Now, quickly, let me explain what an index is, just in case you guys may not know. If you guys know of the S&P 500 or the NASDAQ or the Dow Jones Industrial Average, those are all indices or index. Now, it's pretty much aggregate of a group of stocks. So, for example, under the NASDAQ is listed all of the big tech stocks: Apple, Facebook, Amazon, Netflix, and so forth. So if those stocks are doing bad, as a reflection, the NASDAQ is going to be doing bad, because it's simply an aggregate of most of those stocks. And I think those stocks make up about 25% of the NASDAQ. I could be wrong, but it's something like that. So, okay, so level 1, right now, this is for the overall market in relations to the S&P 500. A level 1 is a loss of 7%, and it halts trading for 5 minutes. Level 2 is a loss of 13%, and it halts trading for 15 minutes. A level 3 is a loss of 20%, and it halts trading for an entire day. So just, let that sink in. If you're trading one day and the markets are going lower and out of nowhere you can't buy or sell, it's because everything is halted, and you have to realize or think to yourself, how much percentage are we down, and see how long that halt is going to last. So this reduces aggressive buying, and it stops panic selling. So when a stock is going up too quickly, or individuals are selling and the stocks are selling off too quickly, it's there. It's pretty much in place to help individuals manage risk. In that period where the stocks are halted, you can call up each other, call friends that are also trading, or simply just look up news, see what's going on, why the markets are going up so aggressively or going down so quickly, and make a decision on what you want to do individually. So it calms things down. So, and there's different types of circuit breaker halts, and you're going to want to know what they mean. So T1, right, occurs when a company reaches out to an index requesting that all trading taking place on their company is to be more momentarily paused, right? This is due to when a company wants to release news or something like that, or make an announcement. So, of course, the news that they release can positively or negatively affect the stock. So let's say the company is selling off aggressively, right? And the board of directors are like, whoa, why is our company selling off? Is this just a technical breakdown? They can then release some good news that they have. Let's say they have some really good earnings report coming out. They can pause the stock, release that news, and let everything, clear up, and let the stock then rebound. So, it's used strategically, and you just, different companies request the halts at different times and for different reasons, good and bad. So you got to know what each halt symbol represents. So this is a T1. Now H10 occurs when the SEC, again, the Securities and Exchange Commission, pause trading on a stock to do an investigation. Now, you want to be careful with this because these are usually done on penny stocks, like below $1. And it's usually when they're going up, pretty quickly. And it's to prevent manipulation, and it's aimed at those companies that are suspected of being fraudulent. So when there's an H10, you want to be careful, because if that news comes out and that company is actually fraudulent, let's say that stock is at 90 cents, I can guarantee you before the day is over, it'll probably be down somewhere close to 30 cents. So if you wait, you see the H10 halt, you want to check out the news, and if it's bad, you want to get out as soon as that stock resumes. So LUDP, this is one of the more common types of halt, and this is a volatility trading pause. So simply when a stock is just going up or down too fast and everything is okay in terms of news. So this is one of the more common types of circuit breaker halts, as it revolves around volatility. This halt usually lasts around 5 minutes and applies to stocks above $3 that moves up more than 10% within a 5-minute period. So note, when the stock breaks over 10%, there is a 15-second window which it must hold in order for the halt to come into effect. So when it breaks above that 10% level, it has to hold above 10% for 15 seconds. If it drops back below 10%, it'll no longer be in that place where it can be halted. So also between 9:30 and 9:45, the percentage required to trigger a circuit breaker halt is doubled. So this will be 20%, right? As the market accounts for that extra volume. So in the open and the close, the volume in the market is at its highest. There's a lot of buyers and sellers in that first 5, to 10 minutes until things really start to calm down. So I'm not going to go over this slide here, but you guys can definitely check it out. It goes over the circuit breaker halt in details in terms of the time frames and that band, meaning that window where it has to hold that 15-second, where the stock has to sustain at least 10% for 15 seconds. So it goes over that in details. You guys can pause this screen here and look over that information. And this stuff is all on the NASDAQ website there. So you guys can definitely check that out, right? So we're going to check out this video here in the presentation. And I'm going to leave these links in the description. So here's the NASDAQ.com trader index. You can check out all the halts and what they represent. There's a bunch of them. There's more that you guys should familiarize yourself with in case you're in that situation. So let's check out this video. And this is simply a stock being halted right now. I marked the time down here already, 21:39. So right here, this stock is already halted, right? MTC, this was on the 29th of August. So these halts happen pretty regularly. And I want to believe this was a LUDP, so volatility pause. All right. So this one is already halted. That's why you're not seeing any movements. But give it a second here, and it's going to resume, right? So out of nowhere, now remember they usually halt for at least 5 to 10 minutes, right? So out of nowhere, this one opened up. Or I shouldn't say out of nowhere, because they tell you when it's going to resume, and it's actually exactly 5 minutes from the time where it closed, right? So this one opened up here, and it's going to get halted. So it got halted going up, right? It's going to get halted going down pretty soon. So I want you guys to see how fast these stocks move on resumption, and what the price action looks like when they get halted going up or down. So let's skip ahead here. I took a position there, small loss. Let's see, where are we? So okay, see that's how quick that was, right? Let's go back a little bit. So the price is at 450, right? 466 is the high, and watch the drop right here. Now it dropped more than 10% within a 5-minute period, so it's gonna get halted going down. So up there at 60, pushing high of day, right? And look at how quick this turnaround is gonna be once it gets rejected. And this is why you want to be careful with the stocks that are halted as well. They're going to be pushing more volume. As you see, the volume down here is going to ramp up on the stock. Right, so 48, let's watch for this dip. It's coming. Give it a second here. I want you guys to really see the price action. So from 40 to 25 to $4, right? 440 to 425 to $4. Now 396, and watch, individuals are still selling here, right? So you're gonna see the price get pinned at this one, or not the price, but the level 2 is gonna get pinned at this one price. So 396, and what's happening here is that the stock is getting halted. So it's going to take this 5-minute period for individuals to really understand what's going on, because there's people in there at 466, right? It's going to take that time to let you clear your mind, see what you want to do. Do you want to hold the position? Do you want to get out immediately? And so forth. So this is what it looks like. It's going to freeze for another 5 minutes or so and then open up. So I'm going to link this video here in the description. And if you guys watch my videos, you know that these stocks are getting halted regularly. So you can click right here and it'll take you straight to the halt level. Again, check out the NASDAQ website for all the halt symbols and what they mean. So another thing you're going to want to get familiar with is margin and leverage. So buying on margin is borrowing money from a broker to purchase stock, right? You can think of it as a loan from your brokerage firm. Margin trading allows you to buy more stock than you would be able to otherwise. So some brokers, for example, E-Trade Pro, they offer 2 times leverage. Short Trader, they offer 6 times leverage. And I believe Lightspeed offers 4 times leverage. So if you put in, $5,000 in there, 5,000 times 2 will be $10,000 that you'll have access to be able to trade with. So a $25,000 account, that'll be 50,000. And if you do 4 times, even on a $25,000 account, that'll pretty much be $100,000 that you'll have access to buy and sell stocks with. Now they don't allow you to use margin on every single stock, because they believe that some of them are a little too risky. So some of the faster moving ones, they'll say, hey, you know what, we're not going to allow you to use our margin, just use your own equity. So, but margin is something that you can look into, it's definitely there and should be utilized. So order types, right? These are some of the more common questions that you guys may have. So when you're buying and selling, you want to know what order type you want to use to give you the most efficient entry in a position, right? So the most common one, and the one that I use the most, is market order. So this fills your position at the current market price, right? If we just remember that video that we were just on, at one point it was at 450, right? So if we wanted to get in at 450, we'll literally hit a market buy, and it'll fill us within that range of like 448 to 451, plus or minus, depending on how fast the stock is moving. So, and there is something called slippage, right? So for example, how that stock dropped from about 450 to 425 to $4. If we had bought, let's say, at 425, there was a chance that we would have gotten filled at $4. So there's slippage there depending on how fast the stock is moving. So market on close is an order type which will be executed as the market closes. Pretty simple. Limit buy or sell allows you to buy or sell a stock up to an exact price. So let's say, you're watching a stock at $3.95, right? But you don't want to get in at anything after $4. You can do a limit buy and it'll fill you up to $4. So it'll fill you in that range of $95 to $4. And then if the stock hits 401, it'll stop executing your order. So sometimes you can get partial fills because of limit buys, but that's okay because you're not buying the stock when it's too extended above your level. So more order types, there's stop limit on quote. So this is when the stock hits a specific price going up, it automatically sells. So stop on quote, stop limit on quote and stop on quote are a little different. So this is when the price falls below a specific amount, you want it to sell, right? So if you're not at your computer and a stock is at $60, you can put, oh, if this stock drops back to $58, sell for me automatically. So that way you get out of the position without any extended amount of risk, especially let's say you have an emergency and you can't stay by your computer. That'll be something that you can do. So earnings, what are earnings, right? So earnings are the net income for a company over a period of time. Now earnings are usually reported quarterly, which is every 4 months. So Q1, Q2, Q3, and Q4. And of course, annually as well, once a year, or sometimes biannual, which is every 6 months. It all depends on the company. Sometimes let's say a company knows that it's not going to have a good Q1 and Q2 for the next upcoming year. They might announce that they're going to do biannual reports or just a yearly report maybe. I guess that'll make more sense. So that Q3 and Q4, sort of balance out those smaller gains that they had earlier in the year. So earning reports can be used strategically from a company's standpoint. You definitely want to pay attention to that as well. Sometimes they're reported a little earlier, and sometimes they're reported a little later. So sometimes a company will report Q1's earning in Q2 actually, so they'll be a quarter behind. So those are all things you want to consider when looking at earnings, and earnings is one of the biggest catalysts or news that a stock can put out there. It really drives the price action up or down. Good earnings reports are what investors really want to see. It means the company is doing well and they're seeing continued growth. So earnings is pretty important. You want to be familiar with that. So you want to be able to recognize a bull market and a bear market. This will save you when it comes to perspective and context, right? Let's say, all right, let's go over the definitions first. So bull market, right? A market of strength. This occurs when stocks are continuously rising. Bull markets can last for weeks, months, or even years. So bear market, a market of weakness. This happens when stocks are moving lower, and these market conditions can sometimes be the cause of recession. So bear markets can last for days, months, or even years as well, right? And going back to understanding that context, you want to know which market you're in, and this can work on a daily basis, a monthly basis, or a yearly basis in the sense of perspective, right? So you don't want to go short long term if you're in the beginning of a bull market, right? Let's say you're trading the overall market. You don't want to go short and you're now starting an upwards trend, and vice versa. So you want to be careful with that. And on a daily basis, right, if a stock is let's say a stock is up 50%, even though it sold off a bit, let's say it was at 100%, but now it's up about 50%. So it came down a good amount. You still might not want to go short because the stock is still in a bullish, trend. So there's things like that you're going to want to be familiar with. And of course, we're going to get into short selling pretty soon. Maybe should have been a little earlier in our presentation now that I think about it. But so dividends, right? This is another thing that you're going to want to be familiar with, especially if you're holding companies for longer periods of time. So this is the profit that an individual will gain from holding a company over an extended period. So not every company offers dividends, but most of the bigger ones do. The blue chip stocks, the big tech stocks, for example, those are always my favorite stocks. They'll give you dividends. Usually they're usually done quarterly, so you can you can get dividends every 4 months depending on which stock you're in. It's also done annually, biannually, and monthly. It's all strategic. It depends on the company. So a dividend is a token reward paid to the shareholders for their investment in a company's equity, and it usually originates from the company's net profits. So if the company does well, you get a good return for your investment, right? And it's also important to note that if a company is doing bad, they're not going to give you dividends. So you want to make sure you're in a good company if you're investing long term and you're looking to get, you know, your you're looking to get some returns from dividends in specific. So, and then the major profit that the company has is kept in their retained earnings statement. So they'll give you some of that profit, and as an investor, if they're doing well, you're going to be doing well. So you want to keep that in mind. So averaging down and averaging up, right? So this refers to the purchase of additional units of a stock that you're already holding. So averaging down results in a decrease of the average price at which you, the investor, purchased the stock, right? So let's say you bought a stock at $5 and it's going lower, but you still believe it's going to come back up. Let's say it drops to 450. You add to your position, and your average cost may drop from $5 to 475. So now you're not down as much money, and when the stock do come back up, you're in good shape. So averaging up is simply the opposite. This refers to the process of buying additional shares of a stock you already own at a higher price. So I sometimes average up. I don't ever average down because I think that's very risky. But averaging up, let's say I'm in a stock at $5 and it's at 520 right now, and I believe it's going to go to 550. I'm going to add extra shares because I already have a comfortable cushion, right? I'm already up a good amount, so I'm going to add some more shares in there and see what it does if it goes up to 550. And even if it doesn't, I'll lose a small amount on that second position, but I'll still be green overall on the first position. So averaging up means you're never really in the red, but averaging down means that you are in the red. So going back to that same scenario, if you're in there at 5, the stock goes to 450 and you add shares, what happens if the stock drops again to 420? So you got to be careful when you're averaging down. So short selling, this one that I just mentioned should have been a little earlier in the presentation, right? So shorting a stock enables traders to capitalize on market declines, right? So the potential losses of short selling are limitless since there's no cap on how high a stock price can rise. Given the potential for large losses, traders need to be more disciplined about protecting their positions, and trading tools such as buy stop orders can help to stop you out if the stock goes up to a certain point. So buying a stock, short selling is simply buying a stock and hoping that it's going to go lower, right? So if you look at this little graph down here, this is where you're getting in. So you're getting in right here, and you're like, you know what, this stock is going to go lower, and this is where you're going to get out, and you make that money in the difference there. So it's if you think about going long, right, buying a stock low and hoping it's going to go high, this is simply the opposite psychology there, right? And now if we switch over here quickly, let me minimize these other windows, right? If we switch over here and look at my order entry window here on E-Trade, let's enlarge this a bit. Now you'll see buy, sell, short, cover. Right now, some brokers only have buy and sell, and you see where it says sell higher down here, right? As opposed to hitting short, you can hit sell, and this allows you to go short, and then you'll hit buy to cover. So it's a little confusing, but not really once you kind of look into it. So short selling, the risk is unlimited, right? And here's why. So when you're going long, right? Let's say you're in a stock at $5. You think that it's going to go to $10 over time, and you have a certain amount of money in there, right? So in order for you to go down to $0, that stock has to go from $5 to $0 for you to lose all your money. When you're short selling now, you're buying the stock thinking that it's going to go down, right? So let's say you're in there at $5 with 1,000 shares, right? So you're in there with 1,000 shares. So every every dollar that the stock goes down, you'll be up $1,000, right? So let's look at it from a long bias perspective. Let's say you're buying the stock hoping that it is gonna go up the regular way, right? So if you're in a stock at $5 with 1,000 shares, let's say it goes to $6, you're gonna be up $1,000, right? Let's say it goes all the way to $10, you're gonna be up $5,000, right? So short selling, if the stock goes down to $4, you'll be up $1,000. If it goes to $0, you'll make that full 5,000, right? But now imagine if the stock goes against you. So you're in high buying thinking it's going to go lower, right? Imagine if the stock continues to go up. Now what happens there, right? If the stock goes to $10, you're going to be down $5,000, right? And you're not going to be stopped out there. So imagine if the stock goes to $20. Now you're down at $5,000 that you had, plus an extra $15,000. So the losses there are limitless. If that stock goes to $100, you're in some deep trouble, and you gotta make sure that you know what you're doing. So, and then your brokers will stop you out because now the loss is unbearable to a certain point, right? And if let's really dive into it, right? So, when you short sell, you're not buying actual shares on the market. You're borrowing shares from your broker, and you're pretty much betting against your broker, telling the broker that those share prices are gonna go lower, and the broker is wrong about the share prices going higher. So when those prices drop, you know, the broker is pretty much paying you. But when those prices go up, you're paying the broker, and if it goes past your level, you know, you now are gonna owe the broker money. And if the broker thinks that you don't have enough money to pay them, they'll stop you out before the loss becomes too crazy to a point where you can't even pay them back. So, that really covers short selling. Again, just to go over it, you're buying the stock in the hopes that it's going to go lower. So that really covers what short selling is. And of course, if you guys have any questions about that, you can also put it in the comments below. So the open and the close, the NASDAQ and the New York Stock Exchange are open from Monday through Friday at 9:30 Eastern Standard Time and closes at 4 p.m. right? And now this is with the exceptions for holidays, of course, and extreme weather conditions, because I remember there was a blizzard last year, and there was a half day because of that blizzard. A lot of investors weren't even able to make it in to the exchange, make it into the office. So they called that day a half day, and trading resumed that following day at the regular scheduled time. So pre-market and after hours. Pre-market is simply before the open. After hours is after the market closes. So if you hear someone saying pre-market and after hours, you now know what they're talking about. And of course, that's going to do it. So leave any and all questions down below. If you have other terminologies that you think I've missed and you want to know a little bit more about, definitely leave it down below. Leave all questions down below. Please ask questions. Now, of course, that's going to do it. Make sure you subscribe, of course. Share the video to all those people that you know who may be interested in the market. Subscribe. Check out the Instagram page. All the handles are the same. Check out the Facebook as well. And of course, check out the Snapchat. All right, give me some feedback down below. Let me know how the presentation was. And of course, make sure you get excited for class 3. Now, I promise that class 3 is going to be out much sooner than class 2. It took to come out preceding class 1. So this one is going to be out pretty soon. And right here, we're going to really get into it. As you can see, trading 102, candlesticks and flag patterns. And this class is going to be a lot of live examples. So we're going to be going over candlesticks, and then we're going to be going over all the live trades that I do, so that you guys can see exactly what I look for and where and why I base my entry points in certain locations. So that's gonna do it for this one. It's been Relentless Trader signing out.